this life ain't fair. And I know that you're going nowhere. Well, don't blame me for what you've done, because I know that you are having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Well, don't you just walk away. That's when I'll say.
Welcome to the Clarified Realty Podcast, episode number 005. I'm Tom Clary, real estate agent, licensed here in the gorgeous golden state of California. Thanks again for coming back. Feeling a bit fiery today. I'm a little bit salty. I'm really chomping at the bit to get right into some really good info today, so we're going to be getting right to it. My guest, once again, is also my sidekick slash co-host, Ron Bruno. How you doing today, sir?
I'm doing great, Tom. How are you?
Good. You know,
excellent.
Like I said, feeling a little bit fired up, feeling like I'm ready to go get them. So,
let's do it. Let's do it.
Before we get started, as always, Ron, have you heard any news out there in the real estate world that is worth mentioning?
I did. Yeah, I came across an article on CNBC about the apparent appraisal shortage issue.
Okay.
Right. So really meaning that there's a lack of appraisers out there. And apparently loans closed in April with Fannie and Freddie, they were 77% on time.
Right.
But recently the percentage has dropped to 66% on time.
Wow, that's significant. I mean,
it is significant.
So we're basically talking about the amount of time that, you know, when we say that an escrow is 30 to 45 days, that it actually hit that target of the 30 to 45 days. And they're saying that there might be, the reason that we're seeing this kind of lengthening of escrow periods is because the appraisals, there are not enough appraisers around to get the job done.
That's exactly right. And it's also increasing prices as well. So the ones that are doing the appraisals, they're actually, to keep up with their business,
right?
They're charging more.
Well, and you, we had kind of briefly chatted about this. You were saying that, what was the average age of?
So the average age of an appraiser out there is 58 years old. So if you think about it. So you have someone who's 58 years old, they're reaching retirement age possibly in 10 years.
Right.
What is that going to look like for the market?
Right. And, you know, they're human beings, and they're, you know, they're basically, their joints are getting, you know, tired and getting up on ladders and, you know, walking around houses and all that. It's only a certain amount of time that they're going to have left.
Exactly.
To do it.
I have my own theory of a business though.
Oh, really?
So, yeah. I think what we should do is, I think Bezos. So Jeff Bezos of Amazon. Jeff Bezos. He should get a whole fleet of drones. And have them drop them off.
Where you're going.
Drop them off at the house.
Right.
And just have someone control it from a control department.
Right.
Fly around the house, take all the pictures you need, and then outsource the actual comps and work to India, and then you have your appraisal overnight.
Interesting.
What do you think?
It's terrible.
Oh, come on.
Terrible idea.
Oh, it's a great idea.
You know, but I will say, it reminds me that there's one thing that's kind of happening out in my world, on the agent world, is that we're seeing a lot of sometimes people taking, when a listing is either sold or on its way to being sold, people are removing the pictures online of the interior of the house. Like people, I don't know if it's people are getting creeped out that like, oh, you know, general public can look in my house and see what it looks like.
Interesting.
My future house. But here's where the problem comes in here, especially with, you know, not necessarily appraisals, but also about doing comps and stuff like that, is one of the things that as an agent, what I look at is when I'm looking at a valuation of a house, I'm going to go, well, what does it look like inside? Does it have a remodeled kitchen? Does it have updated bathrooms? If I can't see the inside of that house, I'm almost as good as Zillow, because I don't have that extra information that's going to guide me to basically making a better valuation on the house.
Oh, that's interesting.
Yeah. So we're not. It's interesting because a lot of people don't know this, but the photographer actually owns those pictures, unless there might be rules on the MLS that say, well, once you put on the MLS, we now own it. But so maybe even the photographer is like saying, well, you got to take them off, or it's just puzzling why we're seeing things disappear.
Oh wow,
interesting. But anyway,
you learn things every day.
So what I want to start off with today, I'm seeing something that has got me a little salty and irritated. It's something that can impact your entire experience of buying or selling out there. I mean, so much is really in your hands as to what kind of experience you want to take away from the transaction. I mean, do you want to be guided in your transaction? Do you want someone who is helping you make the right decisions, assisting you? Or do you want to be led like so much cattle? Do you just want someone to grab you by the hand and just tug you along blindly? I'm hoping that if you're here, I've got a pretty good idea what your answer is, but I think it's important you make that decision or you're just going to be taken advantage of. Let me explain. In episode number 1, we talked about the importance of buying the house and not the market. It comes to buying a house or condo, you should not, I repeat, you should not be overly concerning yourself with the macro, the big picture of the market, right? Instead, you should be looking out for the micro, the specific details of a property, so you can find the details when everyone has stopped looking. Everyone else is listening to the news, the quote-unquote experts, and they're all discouraged. They think that there's nothing affordable out there, because that's what someone said on TV. But you, on the other hand, you say, screw that. You know better, and you start looking in another direction, and you're able to find a great deal. You don't let the headwinds bother you because you're not playing that game. Now listen, I'm not saying that the macro isn't important. You can definitely use that information to your advantage. I'm just saying that if that's the only thing you're listening to, you could really miss out on some great deals. If you're just shutting down because you heard someone on TV say you shouldn't or can't buy, then I think you're making a big mistake. Also, by the way, you never know when the pundits are just flat out wrong. I remember during the housing bubble of 2007, 2008, going around with my wife, and we'd be looking at houses and just thinking there was something going horribly wrong. Something was completely out of whack. But then I like read in the newspaper about how this market is awesome and values are just going to keep on climbing and climbing without any correction in sight. Well, we know how that all turned out, right? Don't we? Just because some expert with a bias or is cashing in on a new book or something tells you it's a bad time to buy, or just because your friend's friend who just so happens to be a WA, a weak agent, told you something he overheard around the coffee maker at the office, don't get suckered in. You need to do your own research. You should have your own knowledge of the prevailing winds of the market, so to speak. And then make your own decision about whether you want to take your boat out on the ocean and sail. Sure, you definitely want to avoid a hurricane if you can, but remember, you still need some wind in your sails in order to make the boat go in the first place. As a matter of fact, if there's a strong wind blowing the direction you want to go, you can get there a whole hell of a lot faster, right? Right? Sure, a strong enough wind can harm or damage your boat and capsize you, but when it's harnessed, it's the very necessary thing that makes your boat move when you're out there on the water. Never forget that. But if you listen too much to the nervous Nellies and you stay in the harbor, you can miss out on a heck of a ride, right? So taking that all in mind, if we look at the latest data from the market, we're starting to see something pretty interesting. Basically, pending home sales, homes where a buyer has made an offer and it's been accepted, and it's in escrow, those are tracking almost exactly the same as last year at this time. If you look at these pending sales on a graph, it would literally look like deja vu from last year. There's no growth, as in more sales being made. There's not a spike down either. It's just the same. It's stagnant. Now, when I hear the pundits and the forecasters talking about this, what I keep hearing over and over again is that the reason that we're not seeing any growth in the market is because of a lack of inventory. Basically, they're trying to say, because there aren't enough houses for sale out there, how can you have more home sales? That would be basically impossible. How can you sell houses you don't have? As a matter of fact, they're saying that because of a continuing scarcity that is going on out there in the market, home values in California are going to keep climbing another 9% this year. And if you were to look at just the numbers, that would make perfect sense. I would get that. Fewer houses, more demand, climbing prices. But here's the deal. I'm out on the streets,
and I'm seeing something a little bit different. I'm actually seeing listings stay on the market for longer than I have in the past year. Expired listings, we've mentioned those on past podcasts, but basically listings where a home has come onto the market and never gets sold, or the agreement between the seller and the listing agent, quote unquote, expires before it was able to sell, those are increasing. How is that possible if demand is so high and supply is so low? Don't get me wrong, I'm still seeing homes going with multiple offers, but I'm also seeing certain homes just sit there. So I think the actual truth is something else, something that no one is considering. I mean, I have my own theories. It's not anything scientific, but I mean, here's what I'm thinking. I'm thinking that sellers don't care if they sell or not. They're testing the market. Remember, we have this big group of people that became homeowners, the baby boomers. They maybe would like to downsize, start their retirement, but they don't have to. For the most part, they've got their houses paid off. So what do? They price high. They price at the top of the market because what do they care if they don't sell? There's nothing that's driving them to pack their bags and move to Florida to start playing golf all day. You mix that in with the millennials who have spent the last 6 or 7 years watching the market implode, seeing their families lose their homes, and I should also mention predominantly saddled with horrific student debt and low wages. Basically, we're at a stalemate. Sellers want to sell high or not at all. Buyers want to buy, but either are afraid to or can't. Pending home sales go down. So where am I going with this? Look, at the end of the day, anyone can take their facts and figures and twist them into balloon animals of their own choosing. But you can't let your fear or an uncertainty about the market rule the day either. Because if you do, it's truly the difference between being led or guided, like I said. When you're afraid of making the wrong choice and you put your fate into someone else's hands, let's say, the weak agent, the WA, or the salesperson agent, the SA, they're going to take those quote unquote facts and figures and lead you where they want you to go. And a lot of times that's nowhere near where you want to go or even what's good for you. When one person is in the lead, that's not a partnership. That's what? A dictatorship. They're using your own fear to drive you. Your freedom of choice and control over the process goes right out the freaking window. That's not something you would ever want, right? Of course not. Well, there's a big difference between that and having a guide that takes you by the hand, that let you know how they see the terrain or the market, right? But you're all in it together. They aren't going to BS you and take you for a ride. No, they're going to go the way you want and protect you on the road or path you choose. And you do have a choice because you're bringing your own knowledge into it. No one can take you down a path that's not good for you because you know better. You already have the map. You know that road over there is a one-way ticket off a cliff. Or that one takes you 10 miles away from your destination. This is how you go through the process with confidence and get to where you want to go safely and of your own choosing. Have your own GPS. Have your own directions of where you want to go and a protector guide to show you where the bumps are. They work for you, not the other way around. And remember, we've said it over and over, buy the house, not the market. If you're hearing contrary things in the market, good time to buy or sell, bad time to buy or sell, focus on the specific properties and the specific things going on with it. If someone needs to move to start a job in Louisiana, they aren't going to care what the quote-unquote market says about selling their home. They're going to want to get out of it as soon as possible and may even be taking a reduction on the price of their house because of it. If you were just listening to the market, you can miss out on a pretty good discount. So what I'm really trying to get down to here is do your own research. Take your home search one house at a time. All right? Got it? Don't let these people who have all the quote unquote facts about the market lead you where you don't want to go. Ron, do you have anything you want to add on that?
I think it's an excellent analysis of what's going on right now. I would say earlier this year, it was very much a seller's market, and listings kept going up and up and up, and there were multiple offers, and we tried our best to present our clients in the best possible way, and that window was very short in being able to present our clients and get those offers accepted because there was so much demand. Now, what I see as an opportunity, so sure, it's down, and it's actually surprisingly down because if you think about what happened this time last year, you had TRID.
Yeah.
Right. So you had TILA RESPA integrated disclosures.
And we're going to go into a little bit later in the podcast what that means, but go ahead.
We'll talk about that. But I remember agents were pretty paralyzed by this new regulation that was going into the market, which everyone thought that escrows were going to be 60 days, and they actually were. They inflated by a good amount. So the fact that we're back at TRID levels and it's a normal market cycle, that's somewhat concerning. That's number one. But I do see it as an opportunity because now you don't have that mad rush to get everything in front of the listing agent and have them where their blinders are on, where they're just going to accept the top offer, and you have to get everything in line and have a perfect offer. Now you can create a dialogue.
Yeah.
Right. So now if you're a buyer, now's the time where you're actually going to get somebody's attention.
Yeah.
Right.
And it's a much more organic negotiating process, basically, because it's not just, oh, all cash, thank you, bye-bye, there's the door. There's more of a conversation happening.
Exactly.
Absolutely.
And then on the flip side, if you're trying to sell your home and you see this nice millennial couple that wants to buy your home, but the price is way too high, well, if you really have to sell, or you're just ready to move on, start a dialogue.
Yeah.
Right. And that's where you use Tom, right? So you use your protector realtor to spark that dialogue.
Right. Well, great. Okay. Well, I think that's about it. I think I got a lot of that out of my system. I think I was a little.
That was good. That was salty.
Just like,
I like it.
Well, I'm just so tired of kind of, people bending and twisting facts and figures into the narrative that they think is the truth. And I'm coming right out and I'm saying, look, I'm not going to come out and tell you, well, here's the facts, and you can, make your own narrative, but I'm not going to try and push you one way or another here because I'm seeing two separate things, and I'm not going to pretend that I know why I'm seeing this on this side that's telling that story, and I'm telling this, and I'm actually seeing anecdotally out on the street this. Who are you to tell me that I'm wrong? So, and it could be a very location-specific kind of thing. Maybe it's a very specific to the San Fernando Valley / Los Angeles thing. So, anyway, well, before we get into the quote-unquote main course of today's podcast, which is going to be our third and final part of our all about mortgages interview with Ron. I just wanted to, urge everyone that if you haven't already, please take a listen to our podcast number 2 and 3. Seriously, please go back, take a listen. They really establish how mortgage lending is the keystone upon which everything else in your home purchase is built upon, and in keeping with the architectural metaphor, with any structure, if you don't start on a very strong foundation, you're doomed to build a very rickety and perilous building. So please do go back and take a listen if you haven't already. But today we're going to be concluding with a conversation about the basically the third and final stage of the process of wrapping up the mortgage approval process and getting your keys. Huzzah! Woohoo! Yay! But before we get started, I wanted to take a very small step backward and go a little bit more in depth about something that back in the second stage, something we started to talk about briefly, and that's mortgage insurance. Why don't you give us a little bit of an idea of what exactly that is, why you need it, is it for the entire life of the loan? Can you get rid of it? That kind of stuff. So if you could, Ron, just kind of go in a little bit more in depth into that.
Sure. So when we last were talking about loan to value, right? Anytime that you have a loan to value below 80, above 80, the lender's going to require mortgage insurance. Right. So 80 loan to value is another way of saying 20% equity.
Right.
So if you're putting down less than 20%, the lender's going to require mortgage insurance.
So let me just to really make it completely clear. Let's say you have a $100,000 house. You can put down $15,000. You are at an 85
Loan to
value.
Correct.
I had to really quickly think about that. And that puts you over. So for that part that you're over, you need to have mortgage insurance.
That's correct. And it depends on your particular lender, right? There are lenders out there on the jumbo side that will actually give you a loan without mortgage insurance. Right? Without having 20% down. Mm-hmm. So there's certain programs that are out there that you can have a loan where you're putting 10% down with no MI. Mm-hmm. You can have a loan where it's 15% down with no MI. That's about where it goes. It doesn't really go into the 5% or the 2% down or anything like that. Now, there is something where, let's say you just are so anti-mortgage insurance and you have a conventional loan. Right. So with Fannie and Freddie, if you have a loan and you're putting down 3%, 5%, 10%, you're going to have mortgage insurance, right? However, you are able to do something called lender-paid mortgage insurance. And lender-paid mortgage insurance means that, let's say you start with a base rate at 4%. LPMI, or lender-paid mortgage insurance, you could get that same loan and pay 4.5%, right? And you don't have mortgage insurance because they build it into the rate. Now, why is that important? Tom's looking at me saying, why is it important? I don't know. Well, think about it. So we talked about that mortgages, the interest on a mortgage, that's tax deductible.
Right.
So if you're trying to maximize the amount of taxes that you're paying, if you're paying a higher interest rate, that means that you're actually writing off more interest. And if you have a higher interest rate, that means your tax deduction is going to be higher.
Right.
Mortgage insurance is not tax deductible.
Right.
So you have to think about that. Right. That is something to think of, right? Now, it is a sunk cost, right? So if you go ahead and get the higher rate mortgage, but you know you're going to be out of there in 2 or 3 years, well, you probably don't want to do a 30-year fixed with LPMI. You're probably better off just paying the mortgage insurance for a couple years and then be done with it. Right. So that's something to think of. You may also want to consider an ARM to begin with, and we talked about that on other podcasts. So that's one aspect of mortgage insurance. You can have lender-paid mortgage insurance.
Right.
The other is, let's say you have a $700,000 home, okay? So you only have 10%. Okay, so that means that you can only put down $70,000, right? So now you're at $630,000. Okay, well, the minimum is $625,000 for a conventional loan, and you don't want to pay mortgage insurance. So how in the world would you structure the loan? Well, you can do what's known as an 80-10-10, right? So you can actually do a loan where you are paying 80% down, right? So I'm sorry, 20% down, and it's 80 loan to value on the first mortgage, right? So you basically take the, you take the first mortgage and it's at an 80 loan to value. Then you add on a HELOC, which is the other 10%. So now it's 80,
Can you
10,
go into a little bit of what a
10%.
HELOC is?
HELOC stands for Home Equity Line of Credit. Right? And a HELOC, the way that those work is you actually will pay, it's typically interest only, and the prevailing rate would be, say, 5.25%, right? So you're only paying interest on the balance, right? But because your first loan is at 80 loan to value, you don't have mortgage insurance. You just pay that HELOC.
Right.
So and you would have to check with your tax professional, but I've heard that HELOCs could be
written off.
They could be written off.
Right.
Is a possibility.
And just as a concept, just kind of so everybody kind of to get this as granular as possible, I just want to kind of step back a little bit. MI is really about because the lenders are saying, okay, they're not putting in the 20%. We basically have to take a bet on them. We're taking basically a bet, and we're going to hedge our bet by basically ensuring whether or not they're going to basically, stop paying us.
Right, exactly. It's insurance for the lender when you do not have that much equity in the property.
Right. So basically, if you have 20%, they're like, okay, they're probably pretty cool. We don't need that extra insurance that they're going to, they're not going to be able to make ends meet. So we're going to go ahead and not do MI. So
that's right. And it's based on a factor. So when we calculate mortgage insurance on our side, it's going to be based on your FICO. It's going to be based on what that actual loan to value is. What's interesting is with FHA, not only is there mortgage insurance, but there's also the upfront premium. Right. So an upfront premium is 1.75% of the loan amount, and that can actually be added to, and typically it is, usually don't pay that out of pocket, but that's added to the loan balance. So that's something to keep in mind as well, that you're going to have this upfront premium. To offset that upfront premium, you do have mortgage insurance that's actually at a reduced rate. Obama, 2 years ago, he actually instituted where he took the MI factor, it was at 1.05, he brought it down to 0.85. Yeah. To make it a little bit easier. And
Thanks,
actually,
Obama.
That's right. Yay.
Thanks, Obama.
Go Obama. So as a result, he was able to bring down and it actually helped families finance more home, which that's a good thing.
Absolutely, because at that time we were really looking for the shot in the arm for the housing market and really trying to get that going, and so trying all sorts of different ways to kind of what's the word I'm looking for, to supplement, get people to get out there off their butts and start looking at homes.
That's right. Now, one option that we haven't even discussed, and this is typical in certain communities, especially like San Diego or Virginia Beach. VA, right? So Veterans Administration.
Right.
So VA loans actually allow you to put down 0% and there's no mortgage insurance. Right. So there's certain guidelines that you have to follow, and you actually have to produce a certificate of eligibility that you are either currently serving in the military or you previously served and you are a veteran. But there are great options available for veterans.
Absolutely. And I'm going to take a little moment here to kind of say some of the things that I've experienced out there. I one time had an open house that I was working at and had a veteran come in and was talking about, well, will you take a VA loan? And I was kind of like, well, why would you even ask? What's going on? And he's like, well, we're having a real hard time because a lot of agents out there don't really even understand the VA process. And so when they have to take that offer that's being made with a VA loan attached and somehow argue for it or argue against it to their seller, they don't know how to explain the whole process, and so they're basically like going, yeah, and there's a VA loan, there's this this deal, but it's a VA loan, and so this poor guy who served our country and really took good care of us is having a hell of a time getting into a home because basically the agent on the other side thinks that it's more hoops he's got to jump through in order to make sure that the loan gets approved and finalized. But it's really if you're a veteran and you want to use a VA loan for your financing your home, make sure that you have an agent on the other on your side who is an educator who can educate the listing agent on why it's nothing to be afraid of, and we can make this happen.
It's just a different path.
Exactly.
And that's really what it's all about. VA, the inspection or the appraisal is a little bit different in terms of that process. There's different, as I mentioned, the certificate of eligibility. So there's different things that occur in a VA loan, but it's just a different path. Just like if you were to do FHA versus conventional versus a jumbo, it's a different set of directions.
Right. And as we first, as part of my question was, it doesn't stay on forever. I mean, it's not something that the MI is not something that stays on forever.
So mortgage insurance. So you have to see what your particular situation is. So if you have, so for FHA, for example, if you put down less than 10%, you will pay mortgage insurance for the life of that loan. Right. So that's something to keep in mind, right? So you're going to be paying mortgage insurance for the life of that loan. You have a 30-year fixed loan. Now, if you refi, you can refi out of FHA.
Right.
Right. So that's number one.
Right.
Number two, you could also, obviously, you could sell the home. Now,
well, what I think Ron's trying to say is that even if you get to 20% equity of the house, like let's say you have it appraised, and oh look, we now have 20% equity on this FHA loan, you're out of luck.
That's right. You could do a streamlined FHA loan where if you have more than the 20% equity, then you can get it where it's actually on for 10 years, right? So that's something to keep in mind. But in that case, why in the world, if you qualified for conventional and you had 20% equity, you would probably just refinance into a conventional loan.
Right. Refi is a much better choice at that point. But, think about it. I hate to put it this way, but think about it from the lender's point of view. You're only putting 3% in. You have 3.5. You have very little skin in that game. They've got to do something to protect themselves, or else.
That's right.
And generally speaking, it's people who are just getting started with their lives. Younger, kind of newlyweds, kind of couples or whatever like that. They don't know what direction their life is going in, and all sorts of things can happen to them. And so it makes sense that the insurance is going to continue for a period of time a lot longer.
Absolutely. I mean, I do an annual checkup with all my clients where things change in people's lives. So we always have that conversation. How are things going? And, I find out that they're going to be selling the home, or that they are potentially looking at a refi, and we look at the rates, and that's what we make the determination. Now, the other loan we were talking about, so conventional, in terms of the cutoff for that, there's different guidelines. So Freddie has certain guidelines for removal of mortgage insurance.
I'm sorry, I'm going to pause you for a moment, because actually through the previous podcasts, one of the things that I think that we didn't really kind of touch upon very, very briefly. Who are these people, Freddie and Fannie, I keep on hearing about? Why the hell do they have such a say over my loan and so if you could very briefly kind of discuss what Fannie and Freddie are.
Sure. So Fannie Mae and Freddie Mac, these are agents of the government. So these are separate groups that are in the past. If you had what's the word I'm looking for? If you had education, if you will, before 2008, these were completely covered by the government, right? And they were going to save them, and that all went to hell. Right. Is what we all noticed.
Right.
But they're part of the government, and they are the ones that buy mortgages from the originators, and then they package them and then put them into securities that investors purchase, right? As part of their overall portfolio.
And they have certain guidelines, basically.
Correct.
That makes it basically they need to make sure that the loan is palatable enough to then go off into another entity, whether is this these securities or whatever. So they have to make sure that they checked every box.
That's right. Sure so they actually set up the guidelines for each of those particular groups. So Fannie Mae has their own set of underwriting guidelines, and the loan has to conform. So we've talked about conforming loans. Right. It means it conforms to those particular sets that is all given to us as loan officers for us to compare our loan to those standards. So we have to hit certain standards because those particular loans, the investor has to know that the client is fits in a certain box, if you will, and that they're going to continue to make those mortgage payments because that's what gives yield in a mortgage-backed security.
Right. So, all right, sorry, go ahead. So you were talking about them in terms of the conventional loans.
Right. So with mortgage insurance with Fannie and Freddie, they have their own removal of mortgage insurance guidelines that will say, based on your loan to value, But the general rule that you want to look at is as soon as your loan, so let's say you put 10% down, okay? So you have a $500,000, you put 10% down, your loan's $400,000. Every time that we originate a loan and fund a loan, there is a amortization schedule, right? And this schedule will actually show you 30 years of payments. As soon as your loan reaches that particular loan to value where it's 80 and below, 80 loan to value, so that's in, say, maybe 10 years or 5 years or whatever that number is, then you can request for removal of mortgage insurance.
Right.
And that's you just making standard payments.
Right.
Now, if you decide that, you know what, I want to accelerate that, right? And you pay and you double your payments. And now it goes from 5 years to 2 years. Well, most of them require at least 5 years.
Right.
Right? So you've made at least 5 years of payments. Now, there's other ways to do it. Let's say that you had a client, I have a client that they bought the home for $712. They put down 10%. They put in about $170,000 worth of improvements to the home. Well, now it's a different story because now you've actually increased the overall value of that property. So what they did is they refied, and we did a cash out refi, and their home appraised for 1.35, right?
Right.
So what that accomplished was they got rid of the mortgage insurance,
Right.
and they were actually had a lot more equity than they began with,
Right.
Right. So their equity was actually, their loan to value is about 59%.
Wow, okay.
Right. So that's a nice little success story, but that's another way to get rid of mortgage
MI.
insurance. Mm-hmm.
Got it. All right. Well, I think that we've now talked about MI, and so I want to turn the corner here. I want to start talking about, okay, the end is in sight. There is light at the end of the tunnel, and it is not a train. Well, at least maybe not a train. We'll decide in a second. So we get the conditions to close. Basically, the underwriter, the loan has gone to underwriting. They say, okay, fantastic. We think that they're approved, but they have to provide X, Y, Z. There's two ways that we can really go with that. That X, Y, and Z is provided, and everything's fine and dandy. Oh, actually, there's three ways. X, Y, and Z is provided. That's fantastic. X, Y, and Z, or X and Z are provided, and Y isn't provided, and there's nothing. Or even X, Y, and Z is provided, but there's something wrong with X, Y, or Z that either creates more of an issue and maybe possibly an issue that can't be resolved. So we'll talk about a little bit more. Let's go into that in terms of, so, okay, give us the perfect scenario first.
Okay, so the perfect scenario, and we actually had this with one of our clients.
Yes.
So Tom and I, we had a client, and what we did, we actually kind of jumped a couple of steps ahead. We actually pre-underwrote our particular client because he was concerned about a particular guideline. So we actually had sent the credit package to the underwriter for them to review and come back and send us what else we would need to complete this file before we even had a property selected.
Right.
Right. So that's obviously,
He just didn't want to get caught with his pants down on the 20th day. Oh, and by the way, let me also briefly start the conversation here about what is considered the loan contingency. All right. So from the contract here in California, the standard boilerplate has the loan contingency up at the 21st day. So basically what that means is that on the 21st day, you as a buyer need to know whether or not your loan is pretty much going through. You got to know it. So you can basically say, okay, later on, if I want to get out of this deal, I can't hold that card and say, I've got the loan contingency. I can't get the loan. And by the way, correct me if I'm wrong about this. Well, actually, I think this is more of a conversation for a real estate attorney, but generally speaking, you can't just throw up the loan contingency card. You have to prove that you couldn't get a loan anywhere, basically. That's kind of what I've kind of heard, is that it's not just that I don't want this house anymore. I think I'll call loan contingency. I can't get the loan. Well, can you get a loan anywhere? That's, it kind of gives, there's wiggle room, but there's not wiggle room. So basically, the loan contingency says, yes, I can get this loan. I am releasing this contingency. I will not say that I can't get a loan at this point, and this transaction is going to finish. That's why it's so important that your loan officer also know that they're working with that time frame as well. And by the way, you can make it even earlier if you wanted to. If there's some, if your loan officer, very few can do it, get it done earlier. Sure, and it's also a good negotiating tactic to say, I can close the loan and and then they'll go, oh, that's fantastic, I'll go with you. So loan contingency but like I said before, contingencies are not passive. You have to actively release it. If you don't release it, they can at any time after that 21st day say, all right, we're going to force you to perform, or we're canceling the deal. So, and then all deposits can be kind of up for grabs and all that kind of thing. So it's always best, get the loan done make sure your loan officer says that they can get the job done before that 21st day. And that's here in California, and that's the boilerplate. So anyway, the day comes, it's the 18th day. You're really getting to the point where you got to make a decision whether or not we're going to release this contingency or not. So go from there.
Sure. So back up just a little bit. So there are certain points when the lender is going to ask for documentation, right? So the first one is at the initial application, right? So we're asking for all the stuff we talked about before. So the income documentation, running the credit, all those items. The next piece is once you've opened escrow, you're going to have a processor, right? So you have a processor that is going to request additional documentation, whatever the original loan officer missed or doesn't usually gather. So that's another piece. Then once they've submitted, so we've ordered the appraisal comes back, everything looks good from that standpoint, right? So there's no changes there. It came in at value.
So we're good.
So now the processor and loan officer, they submit the file to the underwriter. Now the underwriter, our job is to make sure that package is solid, right? That there's no questions and we've dotted all our I's and crossed all our T's. Now, the underwriter comes back and they, based off of the automated underwriting system report that we talked about, right? So for Fannie, it's DU, and for Freddie, it's LP. What we do is the underwriter, they'll actually go off of that list and they'll say, okay, well, you know what? There's a missing document, right? So we need that document. So they will start writing down, here's all of the things that are missing for this file to be completed.
You left this space blank.
That's right, exactly. Or, you know what? We need an explanation. We need a letter of explanation.
Go more in depth.
Go a little bit more in depth. We need to, because what's really important is this is not just so the underwriter feels good about the file. And that's what a lot of people don't understand.
Right.
They're like, oh my God, like what does this underwriter want?
Right.
Well, it's not what the underwriter wants. And you're not trying to convince the underwriter.
No.
And he's a judge. It's not that. You are piecing together a file that other people will look at and don't have the benefit of talking to you.
Right.
And bugging you for forms and everything else.
Right.
It is a living, breathing document that travels all over the country.
Well, and also on top of it, they have guidelines that they have to hit. And on top of it, I know that you're a wonderful, fantastic human being that goes to church every single week and all that, and that you're completely trustworthy. But guess what? They can't take your word for it. There are certain things that later on, their butt's going to be on the line. It's like, why did you give them this loan? And they're going to have to point at something and say, you saw that there was this problem. Oh yes, but I got this in return that covers my butt.
That's right. So the underwriter, they have to protect themselves, right?
Right.
Because
they're saying yes. They're saying green light.
That's right. So I would say the most common requests that are out there that underwriters ask for is a LOE. So an LOE is a letter of explanation, right? And it could be anything. It could be a job gap. It could be, and it's all based off of the particular lender that we're sending the deal to, right? So FHA has different guidelines than a jumbo lender, right? So they're asking for particular letters of explanation that are based off of that particular lender, right? So letter of explanation, that's number one. Number two, I would say any large deposits, right? So if there is a deposit in your account that you've submitted that is larger than half of what you earn on a regular basis, you will be asked a letter of an explanation of that deposit, large deposit. Right, because what they don't want to have happen is they don't want all your relatives to send you $5,000 here, $6,000 here, right? And they're like, well, where are you getting this money?
Yeah,
right. You can't just receive money. It has to be gifted, right? There has to be documentation because there's gift guidelines and everything else, right?
Right.
So an underwriter will ask for those deposits, right? So any large deposits. I would say other requests. If you're missing a pay stub, right? So you have to make sure that we have at least 30 days of that pay stub. They may also ask for and then there's also internal ones too. So it's not just based on what the borrower is being asked for. They have
their own policies,
lots of conditions,
inside,
right?
Yeah.
So and what all of this is it comes back to the loan officer and the processor in the form of a conditional approval.
Right. And by the way, I want to also interject here. I had a client, and some of these conditions, you kind of scratch your head and you go, God, that's so intrusive. Even like it's like, why do they need to know? That's like crazy. Why do they need to know that? I had a client that they asked her, we need a copy of your divorce agreement. And it's like, well, why would you even need that? That was 5 years ago. Why would you? Well, guess what? There is something very specific there they need to know. They need to know are you paying spousal support? Is there a chunk of change going out every month that isn't accounted for? That you're writing a check to somebody that you're obligated to pay? There's a reason for it. It's not like they're just trying to find out personal information about you, and you shouldn't take it personally.
That's right, and that's the biggest thing is you can't take it personally. The underwriter looks at this as an uninterested party. They're looking at this as a business, right? So you have to think of your loan as a business loan, right. So it doesn't sound unreasonable if a business is being asked to produce certain documentation, and yes, it's a little uncomfortable because who wants to see their divorce decree?
Right, again,
right.
I got to dig that out of the closet.
Yeah, that's always awesome,
right? It's like, that's a reminder of my my failures.
That's right.
Yeah, no,
that's
absolutely.
Right. We call it California starter marriages here, but so those are things that you have to have with a grain of salt, and just know that this is a relatively short period. You're not being asked for this for the rest of the year, right? So it's just, yes, it seems a little intrusive, but it's required because we need to complete that file. So the conditional approval, what happens is underwriting, they've completed their review and they've given that conditional approval list. So what I do as a lender is I go through it first myself. I see if there's anything on here that is going to raise any red flags or is going to be difficult to obtain based on what I know about the client. I then review it with my processor on what the borrower needs to produce, but also what needs to be produced internally, right? To make sure, is there anything here that's going to be an issue? 9 times out of 10, everything's going to be fine. Then I approach the borrower and I work with my processor, and we just give the list to the client, and typically we're submitting the list and we're following up with a phone call to explain exactly what we need. But I'm only sending them what is required. I have seen it in the past where other lenders will actually send the conditional approval, which is this list of 50 gnarly things that the client needs to provide or whatever needs to provide to close this loan, and it confuses the hell out.
Yeah, of course.
Right. So that's not.
And it can be daunting. It's another part of that fear aspect of it. It's like, oh my God, how am I gonna? Well, first of all, I'll take it one bite at a time. And lots of times it's like, oh no, you already have that. I already sent it to you, and just say it's in part of this packet that I emailed on that day. You probably already sent it to them. So, and it's got lost in the pile or something.
That's right. That's right. And I do sometimes push back too. Sometimes I find that because the underwriters are human too. Right. If I find that, and this helps me feel smart, but if I go back and
he needs a lot of help.
Right. Exactly. Yeah. So if I look at a file and I see that, well, you know what? I looked at that particular lender and this isn't required. We will push back on that. Right. And I've escalated files because I felt the underwriter kind of dug in their heels, and it turned turned out in our favor. Now, we've also had files like we were talking earlier with our, Tom and our success client, where there were 0 conditions asked for by the
that was
underwriter.
so nice to see.
That was beautiful.
Like, what? This page is blank. What's wrong?
Man, it was
Was their printer broken? Is there something?
But it said conditions from borrower, and it was none. It was amazing. And what was crazy was I had a refi on that same day, and it actually was the exact same thing.
Oh, really?
Yeah.
Wow.
At the same day.
Hat trick.
It was a hat trick. It was amazing. It was a great feeling. Now, there were things that had to be done on the internal side, but they were all standard.
Right. So, okay, great. I think we got to move on. We're actually deep in here, so I want to make sure that we get everything covered here. TRID, I want to go into that. Basically, what is TRID? What does it protect? And what is the effect it has on a loan? TRID means...
TILA RESPA integrated disclosures.
Okay. And basically
flows right off the tongue.
I swear it's so eloquent. And it started last year, and it was basically, and I know that from our side, on the agent side, there was a lot of panic here because, look, at the end of the day, we have widgets going down a conveyor belt, and anything that kind of, gives a little bump in that conveyor belt or, can snarl things, it doesn't go well with agents, basically. And there was also a lot of talk from the loan officer side also that, it's like we don't even know kind of how this is going to affect our system and how it's and so you guys, and so like we did things like we took, usually you have like a 30-day escrow. They said give it another 15 days, 45 days, just because we just don't know. We have no idea. And I think we're pretty much back down to 30 at this point. I mean, most things are getting done in that period of time, right? I mean,
yeah, I would say aggressive is 30 on a purchase of a home. If you're looking at a condo, maybe 10.
Well, just
more
because
days,
there's
like
so
40.
many
there's so many moving
parts
with a condo,
right?
I usually have my agents start at 45 when they're submitting the initial contract, and if we can beat that day, then fantastic. But if they need to be competitive and we need to get down to it, 30 days.
Yeah. And it's all about the edges that you can, give to your client. So can you do this a little earlier? If you can do it a little earlier, people want to be closed earlier, usually, generally speaking. So it gives you the edge. But go into a little bit more detail about TRID and what was it?
Sure. So TRID, I guess the history of real estate time, there were 3 main documents. You had the good faith estimate, the GFE, you had the TIL, truth in lending, and then you had the HUD, right? And these 3 documents were issued at the beginning of a loan. And what was interesting was there was a lot of fudge factors when it comes to all that initial disclosures.
Yeah.
I mean, people just put down
not rules.
It really was. I mean, people just put down whatever, and everything was padded, and you were able to just put in these numbers, and it kind of looked like what the client would end up paying at the close of escrow, but it was nothing that was being held to at a particular standard.
Right.
Now, at the very beginning, there is a loan estimate. Right. It's replaced all 3 of those forms. And the loan estimate will actually show, here's what the monthly payment is. So the principal, interest, taxes, and insurance plus HOA if it's a condo. And it actually will say, here is the cash to close. So the borrower knows exactly that, they're going to have to shell out the $50,000.
How much they have to open their wallet for.
That's right. And they also will have a list of itemized costs associated with that loan. Now, there's certain tolerances, right? And if you go above those tolerances, the borrower doesn't have to pay it. Right? So we have to make sure that when we're disclosing to the client that these are accurate. Right? That's the most important. So in the beginning of a loan, what's the most important thing to do is send in your earnest money deposit right away. Because escrow needs to give those fees to the lender so that we can disclose those costs.
To put it in a more kind of, real world way, it's the starter's pistol. I mean, it's literally nobody goes until, well, does he really have money in the, he's got money in the bank. Oh,
Exactly. Escrow doesn't wake up until the money has hit, the wire has hit their side.
The deal ain't for real.
Exactly. So you want to get that in right away because that gives me the permission to say, send me your fees.
Right.
Once I get the fees from escrow, I put them all in, I review them, have any questions, I ask the questions, and then I send that to the processor. My processor then submits the LE, the loan estimate. Now, there's certain lenders that will require you to hand sign it. Our particular case, we docu-sign it, which is awesome because you could be on the 405.
I literally can't imagine a time before DocuSign.
I know.
It boggles my mind.
Oh yeah, people had to print things out and scan it and fax it in some cases.
I mean, I hear stories from the old timers, of signing their RPAs, the residential purchase agreement, contract on the hood of their car. And that, and I go, what? How does that even?
I mean, it was just last year before, I joined the company I'm with now, where the client had to print out 30 pages of initial disclosures and hand sign every single one of them.
Right.
Sign and date.
Yeah.
And, they became very intimate with those forms.
Right.
And they read them. And I had some clients where I had to read every single basically word on those pages, but they wanted to, right? So I'm happy to oblige.
Right.
So you've docu-signed the loan estimate. Fantastic. Now it gives us the ability to order the appraisal. Right. And now the loan is off and running. Now, at the end of the loan, you also received the GFE and the HUD and the TIL
before,
but now you have what's known as the CD, or the closing disclosure, right? And the closing disclosure will show you, okay, yes, this is your principal, interest, taxes, and insurance, your PITI. Here's the cash to close, and compares that to what we had when we submitted the LE. And it also shows, is there any variance? Because things happen, right? There's things that happen in the loan that, and during the purchase process that are out of our control. And it's just a checks and balances. But again, that CD needs to be disclosed 3 days before we can actually sign loan documents.
And I want to stop here because this is huge. This is where if something is going to go wrong and basically delay everything, this is exactly the moment. So go ahead and explain why.
So the reason why is because the CFPB, so the Consumer Financial Protection Bureau, they're the ones that actually created TRID, right? They felt that consumers were essentially getting screwed. And
by the way, it's commonly kind of, in the vernacular, it's know before you owe. There's kind of the know before you owe regulation, basically, this thing came out as. And they wanted to make sure that everybody was educated that at the beginning, you were going to be this, and at the end, do you have that? Yes. So if there's a discrepancy.
Exactly. So they wanted to make sure that before you sign loan documents, you know that you're going to have to bring X amount to cash to close. This is what your closing costs are, and this is going to be your payment that you're going to be paying, right? So it's important for the client, once they receive that CD, to sign it, right? And if you have any questions, you can ask. You're absolutely allowed to ask, and I encourage people to ask because I want them to know what's going on. But and once you've accepted that CD and you've docu-signed it or hand-signed it or acknowledged it, whatever your lender requires, then 3 days, and it's 3 business days, including Saturdays, not Sundays and not holidays, right? And certain holidays are kind of funky because we just had Columbus Day, and Columbus Day is actually, we were able to count that in a CD, but not in a refi with a 3-day rescission period, which drove me nuts because I had to actually get a 1-day extension, and it was, so that's a whole nother story. But that's something to keep in mind, right? So once we've gotten the CD and you've signed it, then we wait 3 days, and now you can sign loan documents. Right?
Right.
So the way that works is, let's say it is a regular Monday. You've received the CD Tuesday, Wednesday. First day you can sign, it's Thursday.
Right.
Right? So you can sign those loan docs on Thursday. So now the next piece is you've signed your loan documents, and it's really exciting because you've spent an hour and a half hand signing. You can't DocuSign loan documents.
Right.
Right? So you actually have to hand sign those.
You still need to do.
And you have to have a notary present.
Right.
Right? So typically it's going to be your escrow officer that arranges the meeting.
They haven't figured that one out yet.
No, and you can sign them I've had clients that signed it actually at my office. I've had clients that, they'll sign it at the actual escrow's office, or most common I would say is either they go to the, your personal office or to your home. right? And you sign those loan documents. The notary then collects all of those notarized documents, and they give that back to escrow, right? Now, once the documents are at escrow, the people on our side of the lending side, we have funders or closers. And what their job is, they need to make sure that they're reviewing the conditions, because there's a couple of different conditions. You have the conditional approval, right? So here are the conditions that need to be completed prior to loan approval. There's conditions for docs, right? Here's the conditions that need to be completed prior to issuing docs. And then you have conditions to close, right? So you have to make sure that we have all the conditions to close already all met, right? But so provided we've done that, escrow and the funder, they're going to go back and forth and work with title. And if there's any outstanding signatures that need to be done, that's escrow's job. They go out there and they gather all of the signatures from the buyers and the sellers and agents, whatever needs to be completed. Then the two of them, between escrow and the closer, they will say, okay, we have the final and we're ready to fund, right? So they will send the funding figures, and then they will issue the wire.
Right, which goes into the accounts, and basically escrow sees all the debits and credits all match, and you are now a homeowner.
That's right. That's right. So that's the celebration. So typically what happens is you fund on, let's say, Monday, and then the next day you record.
Right.
Right. So a recording actually means that you are recording title in the name of the new owner.
Right.
And that's when you get your keys.
Right. Exactly. And not before that. All right. Well, I have to kind of tie up here because we're running a little bit long today. A lot of great information, but I want to make sure we all get it. But I just also want to make sure that we're not going too long here. But I do want to touch upon very briefly the phenomena of, I remember my first home that I bought. And I'd been living in it. I felt great. We actually had been renting it, and the homeowner, had said one day, I'm on a adjustable rate, and I just can't pay it. Do you guys want to buy it? And got a great deal on it, and it was fantastic. But then I want to say it was like 3 months later, 3 or 4 months later, I get something in the mail, and it says, your loan is no longer with X, Y, and Z Bank. I'm like, what? What does that mean? Who did that? I didn't do that. So explain that phenomena of basically, even though you might be going to Bank of America, Wells Fargo, whoever, guaranteed rate, they're not necessarily going to be the ones that you stay with.
That's right. So it depends on the mortgage bank or retail bank or broker that you're working with, and it depends on that particular program. So our jumbo lenders, so if we're doing a deal with Chase, the servicing is most likely going to be done by Chase, right? Because we're selling that loan directly to them, right? But if we have a Fannie and Freddie loan, guaranteed rate, we do actually service loans, but we also sell loans, right? So we may sell it to Wells, or we may sell it to another servicing company. But the idea is that you have the actual loan itself, right? The note, and that can be sold to a particular company, and they keep that on their books, and it's packaged as a security. And then you also have the servicing, right? And that's the actual payments that are being made on your loan. So what happens is you close the loan, you've recorded, and let's say it's November 5th, right? Okay, now there is a holding pattern, right? I mentioned on a previous podcast, your payment isn't due December 1st. It's actually January 1st because you skip, right? So you skip a month. During that whole transfer, your loan is now going to be assigned to a new servicer if it is assigned to a new servicer. So what happens is you typically make the first mortgage payment with your mortgage bank, right? So in this case, guaranteed rate. So you make your first payment to Chicago, Illinois, and you call them up on a phone or actually send in the physical check. Then you get all this information in the mail saying that XYZ has taken over as your servicer, and that's where you could set up those automated payments and set it and forget it and just make sure your mortgage is paid. But you will receive communication, and your loan officer should have that ability to find out what's going on with your loan. But give it, I would say, at least 3 weeks before any any information is out there, because it goes through a series of checks, right? So once a loan is funded, and this is why we have to, and the underwriter, we have to make sure, because once the loan is funded, it goes through a quality check, right? So there's a whole after funding group that will look at the loan, and then you have if it's being sold to a servicer, they're going to look at it as well. So when we do that loan, we need to make sure that everything is completed, because having to ask a borrower after escrow, that's a pain. Yeah. That's not fun.
Yeah. So, really briefly, why would one lender sell a loan to another lender? I mean, or another bank or another. I mean, generally, is it cheaper for them to just kind of, well, we don't want to, we got the origination fee, now we kind of just hand it off to somebody else to make the interest on it, or what's the thinking?
It's a business.
Yeah.
It's a big business.
Yeah.
Right. Originating loans. It's not the 1% or 1.5% commission that the loan officer receives off of the loan amount. It's the back end, right? It's being able to sell a mortgage instrument and sell the servicing as well as selling the note. So it all depends on the particular company, but there's a lot of money.
Yeah.
If you're originating loans and you're able to sell them off to Chase or Wells or whatever the Union Bank, whatever the loan is, because of there's a lot of dollars to be had.
Well, and also I think, correct me if I'm wrong, but sometimes you sell off a portion of your mortgage library, let's say, so that you can make more loans.
That's right. So
you have more cash to make more loans.
That's right. So for example, our relationship with Chase, we have I don't know these specific numbers. I'm just going to say $100 million. Right. So we have a line of $100 million where we're originating all these loans, and we get to that $100 million, and then once they're all completed, then we move it off the books.
Right.
And now we start over fresh.
Right.
Right. And that also is when we lock a loan, we're locking that loan in place, because those are all future loans. So that's why a lock is so important, because we're locking with a certain investor. And to keep rates down and to be competitive, we have to maintain a thorough throughput. Right? So that is what's really important. And that's why we do that process where we go through and analyze it every which way before locking the loan, and making sure everybody understands what it all means. Because you want to have a solid throughput, because you don't want to have a pipeline where you lock it and now you have to break the lock and then you have to extend the lock. You don't want that. You want something that is just a nice, you mentioned assembly line. So that's kind of the idea.
Right. So basically the reason I bring it up is just, look, you want to try and reduce the amount of surprises that you get basically in this whole process. And so I'm saying, don't be surprised when you open up your mail and you find out that your loan is no longer with Wells Fargo.
That's right.
It's not with, it's a very common practice.
That's right. And one other surprise that we didn't bring up, but I want to mention it. You've heard of the term clear to close. Right. So back to when we were submitting those conditions, and the borrower, they've submitted everything, and internally we've submitted everything. We send it to the underwriter. Well, the idea is that hopefully the underwriter clears everything. But they may ask for another set of conditions, right? So that's something to keep in mind, and conditions can actually create other conditions, right? So it's very important to whatever you're submitting that we are making sure that that's not going to raise further questions, right?
Yeah, and also it's so important for your agent, your real estate agent, to be in good communication with the listing agent, because they should be the entire time be going, things are going great, things are going good, whatever, so that when, you're not just radio silence, because that creates so much more problems if you're just quiet. Actually, when things go quiet is when you kind of know, there's something going on over there.
Right.
And so if there's some sort of condition that has not been met, it's so much better if it's something that they can meet, right? The agent is on the phone going, all right, so listen, we want to be upfront. This is what's going on. Let's work together. Let's make this not a non-issue. That's the key. It's like,
that's exactly right.
I always keep on saying that. It's just like, let's make this a non-issue. Let's just work. We still want this house. We still want to, our heart's devoted to it. We're still in love. don't break up with us. We're having this issue. And then there is that instance where the conditions can't be met.
Right. And, not everybody can stay in that bubble, right? So things happen to people's lives. I mean, I had a borrower, I was telling you this
right.
story.
Yeah, that's the case.
Right. So I had a borrower, definitely not naming any names, but what happened was he was working for XYZ company. And on the day we were putting together the loan documents, the funder called out to the employer and wanted to do one last verification of employment. Well, we found out that the borrower had switched jobs. Changed jobs.
That's cool.
On the day we issued the
Perfect
loan
timing.
documents, the day before they were going to sign that thing.
Wow.
Yeah.
So, but life happens.
So, I happened to find out from the borrower the reason why the other person was being, a little bit, they weren't answering their phones. Well, okay, that's the reason. HR is not going to respond because he was no longer with that company. But we were able to handle it, and we were able to actually handle it in a very quick way. But the point of that is, the fortunate thing was that he actually received a raise, and he was going from full employment to full employment with no job gaps. Right. So it was
it's
kind
a
of
better situation,
a much better issue. But those are key pieces, because if there is anything that changes by the time that you are signing those loan documents, we have to know.
Right. And
we have to know.
And by the way, it can be something as look. There's a completely different situation between what you just mentioned, and if you go buy a goddamn Maserati on day 25 of your escrow, you are an idiot and you get everything you deserve, because you are screwing with everything. You're screwing with your credit, you're screwing with, the cash you got in the bank and all that, and you should know better.
That's right. So what's really important to know,
I have no pity for you at that point.
Exactly. So know that the underwriter or the funder, once you get your clear to close or once you get your conditional approval, that doesn't mean that you can go out and go to Vegas and go crazy.
No.
Right? It means that, okay, things are going along, but you need to make sure that that if your employment changes, you have to let your loan officer know that right away. If you know that there will be a soft pull on your credit, right? So you can't go buy all the furniture for your new home because you got your conditional approval.
Everybody starts shopping for, oh my God, I'm going to do this with the living room. I'm going to do this. And it's like the credit card going up. And
exactly.
Like,
I had a client. She was very responsible. And I told her on Black Friday, she couldn't use her credit card.
Don't go near it. Don't look at a shopping center.
She was heartbroken. And I said, get a loan from your mom or whatever. Right. But do not use credit, because we have to keep you with those, what are those things when you bowl, those things on the side?
Oh yeah, those like little
the guards.
kitty guards.
Yeah, the kitty guards, right? So that's our job as loan officers, to keep those kitty guards up, especially when we're coming in to close. You have to think of a loan as almost like you're taking off on a plane, right? So you have to be very sure that once you start everything, that everything is in motion and that you're moving forward. And once you're in the air, you can veer off course a little bit here and there. But when we're ready to come in for landing, you better be solid. Right. And that's our job, is to monitor and make sure that everything is going the right way, because we don't want anyone to crash and burn.
Right. And please don't have the illusion that when it's a loan contingency is up in 21 days. Everything, your loan officer says, okay, you're good to release the contingency. Things still happen. There's still underwriters out there who are like finding the last they'll find things and all that. It's part of the process. But at that 21st day, because and here in California, that's what we have in our RPA. You kind of have to have you got to have a good enough relationship with your loan officer that you believe them when they say, look, I think we're good. You have to do it. We might get another, 2 or 3 conditions or something might come up. It happens. But you have to have enough confidence in your loan officer that they're telling you that you're good to go. Yeah.
That's right. And that's all part of being open and disclosing and sharing everything what's going on in that person's life. Because the more we know, the more we can kind of put ourselves in the borrower's shoes to look at the conditions and say, is this something that can be attained or not?
Right.
Because if it's not, then we need to pull the plug.
Right.
And we have every right to do so.
Right. All right. Well, I think we've got a lot of ground that we've covered here. I think it's incredibly value, but I think that just about wraps up our deep dive into the mortgage world. And while I think we've done a very good job of covering a lot of ground, by no means have we shown you the entirety of the terrain. There's still a lot more nooks and crannies out there for you to get to learn about, and we'll make sure that we keep communicating those to you. Ron will be right here. He's going to be putting in his 2 cents here and there, educating you guys, and bringing his perspective to every facet of the process. How loans, basically, the loan is affected by everything in the process. And so, our goal here is that we want you to be able to travel through this process with confidence and maybe even enjoy it a little. I know it might seem crazy, but there's no reason that you should be afraid of this, and you might even get a kick out of it. And this is, it's not some sort of insane alchemic magic that only a wizard like Ron can know. This is very easy to understand stuff, and hopefully with what we've talked about over these episodes, you'll put the fear behind you and not be afraid of starting the journey. So why don't you go ahead and give the folks the info where they can contact you.
I can be reached at ron.bruno@rate.com.
Now, this has changed in just the 1 week that we've had this podcast. He's gone from an email address with guaranteed rate to just rate. It's like share. They only need one name, right?
Exactly.
They're now just rate.
If you're a mortgage company, rate.com is pretty awesome.
That's pretty awesome.
That's pretty awesome. So the name of the company is still guaranteed rate, but rate.com is the domain. That's what we have. And I can also be reached on my cell phone, 310-804-8243.
Great. Well, thanks so much, Ron. And you can definitely also find us on our Facebook page, facebook.com/Clarified Realty Podcast, all one word. You can even email me directly at tom@clarifiedrealty.com. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. I'm on Snapchat, Twitter, and Instagram as well. My handle for all 3 of those are @ClarifiedRealty. I beg of you, please leave feedback and reviews on iTunes or in the comment section on our page. My amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs. And please go check them out and like them on SoundCloud. We'll also leave a link to the song in the credits. They rock so freaking hard. My ears are still ringing from playing their stuff in my car a week and a half ago. And just a little disclaimer, Ron and I are licensed by the California Bureau of Real Estate. My license number is 0171-5353. Ron's is
guaranteed rate NMLS 2611, NMLS ID 558706, California.
The advice we give is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. And that's about it. Ron, you good?
Fantastic.
Well, thanks for coming by, everybody. And remember, the greatest thing you can ever do is make someone feel at home. Take care, and we'll see you next week.